everybody. Welcome to the monthly market insight. This is for October, so welcome. We have now fully kind of hit fall now. I know mornings are getting cold here in Colorado, and I'm sure they are in Ohio as well. So welcome for our clients that are on here now. We'll also, just a reminder, send a recording of this webinar as we do every month in case you miss it. We'll also resend the election webinar that we did a couple months ago. Now that we're going to be hitting, full steam into election, you're getting bombarded by ads and media, and you'll get your, election votes in and everything. We'll have one more webinar right before Election Day on the 5th of November. So we'll send that out too. We've had some conversations as we're meeting, third quarter with clients, just to reassure them and give them some insight on some data to make more informed decisions and understand the market a little bit as we get close to the election. So we'll send that. But as we get into October, Sean, a lot of people may be honing in a little bit more into the market and trying to understand, the ebbs and flows. Why is the market up? Why is it down? The Fed reduced, interest rates. We thought that would have a big boost, in performance. So tell us a couple key measures and how that's going to impact, one, what the Fed rhetoric's going to be about interest rates and how the markets may react to that.
Yeah, so I think the key thing is the Fed doesn't necessarily know what's going to happen in the next 60 days. So certainly I don't, or really anyone else. But the Fed has been very clear that they're looking at the data. And the data that they're focused on most closely is going to be the unemployment number and then the CPI, the Consumer Price Index, an employment number. Because if we start to have jobs become available and people get laid off and that unemployment number rises, their fear is that we enter that recession. And it seems like for the last 2 years now, every time I pull up my news app on my phone, there's this talk about fear of recession, fear of recession, fear of recession. And it just never comes to fruition. But we have seen the unemployment number rise really over the last 6 to 8 months. Now, we got the unemployment number last Friday. So it comes out the first Friday of every month. And so we got that last Friday. We saw the unemployment number drop. So as we were slowly seeing the unemployment number rise, we saw a data point where it dropped. Now, what happened, right, in the previous month was the Fed lowered interest rates. So if you really look at kind of how the markets performed so far in 2024, we had the Fed coming out last November of 2023 saying, hey, we're going to be lowering interest rates. They expected to lower them 3 times in 2024, but the data kept coming out that inflation started to rise. So we had a great start to 2024. Markets were up from January through about the end of March. Then we saw that inflation number rise, and we saw the markets pull back. And we lost almost all the gain we had in the first 3 months over the next month and a half. And since then, the markets have kind of taken off because we started inflation coming down again. And so inflation's been trending in the right direction, and it dropped to 2.5% last month. We'll get the next inflation report this Wednesday, October 10th. Or is that Thursday? I think that's Thursday. So we'll get the next unemployment number on October 10th. And if that number goes back up, that might mean the Fed could lower interest rates again. If it drops, then Fed might say, hey, we just lowered interest rates 0.5% in September. Plus, we had the unemployment number in September, right, last Friday, start to fall. So it went from 4.3 to 4.1%. So that was a drop in the unemployment number. So we saw the unemployment number rising. The Fed said, okay, let's lower interest rates. They shocked the world, really, by lowering interest rates 0.5%. So they were at 4.25 to 4.5. They dropped them to 4.75 to 5.25. So we saw them lower interest rates 0.5%. Everyone was expecting the Fed in September to lower them 0.25%. So we did get a little, uptick in the market. And now we see the unemployment number fall a little bit. And so the market is now saying, you know what, maybe the Fed's not going to lower rates again in 2024. So they come out and, again, they continually say, we think we're going to lower them. Data comes out and they say, you know what, we're not going to lower them yet. And so we saw a good market run from really May through the end of July. Fed made an announcement on July 31st that said, we're not going to lower interest rates. The market was pricing in that they were going to drop 0.25%. It decided not to. They waited till September when they saw unemployment number tick up. And then they did something that we weren't expecting and lowered them 0.5%. So I think the key point in all that is the Fed does not know what they're going to do. right? Every 60 days they come out and they make an announcement of about what they're going to do with their interest rates. And their message has not been consistent, or their action has not been consistent with their rhetoric leading up to that point. So it keeps everyone on their toes. And the market likes certainty. It doesn't like uncertainty. So right now we're seeing the market, kind of pull back Friday and today, and that may be based on what happens with inflation on October 10th. So if we see inflation tick up, it might mean that the Fed would be more willing to lower interest rates again in 2024. Or if inflation actually drops below 2.5%, the Fed may say, you know what, we lowered 0.5%, things are good. And really where we're seeing this conversation play out with clients over our last quarterly meetings has been, should I buy a house, right? I'm about to buy a car. Should I borrow money to do so? I'm about to do a project in my house. Should I borrow money or should I use cash? And again, we kind of go back to this hurdle rate and saying, hey, we don't know what's going to happen with the interest rates. The Fed doesn't know. Certainly, we don't know. So let's make our decision based off of all the known information we know right now, which again has been different than it really was over the last 18 years when borrowing costs were low. If you want to buy a house at 3%. We had clients get houses at 2.25 to 3.25% for a really long time. And now people are buying houses at 7.5%. So now our advice has been, let's probably put more cash down than we would have 2 years ago. So that's really where we're seeing this conversation evolve. And people are saying, I'm just gonna wait for interest rates to drop before, I buy a house or buy a car. And we keep saying, we don't know that they're going to continue to fall. And so we're looking at the data as it comes out. What makes sense? Should I put more of my cash down? Should I, go out and finance more? Those are kind of the way that we've been helping clients really over the last 8 months or so in dealing with borrowing costs versus using cash. Now, what we've also seen is a push over the last 18 months or so where banks have been offering pretty good high yield savings accounts. For almost 20 years, banks were offering savings accounts of 0.25, 0.1%, and that amount just wasn't keeping up with inflation, even when inflation was at 2%. So there really wasn't a whole lot of incentive to people to park their cash there. And so we're telling people, hey, put money in a brokerage account. We'll take on less risk with it, but we can outpace inflation. Banks have been able to be competitive, and they're offering high yield savings accounts that are paying 4.5 to 5%. And so that's an attractive option to park cash. Now that may change if the Fed continues to lower interest rates. Our advice may change on that and say, you know what, it's time to get out of a high yield savings account and kind of go back to a brokerage account. But those are some of the ways that we've been helping clients is, where are some options that I could put money? Am I going to earn a higher interest rate than I would in a market? And is there a safe place for me to park money? And then what should I do with my cash when it comes to me after making large purchases and borrowing money versus using cash? And so we continue to look at the numbers that it feels like a broken record we've been talking about for about 2 years now. And that is what's happening with unemployment, what's happening with inflation. We're seeing a good trend in inflation. It's dropping. Like I said, it dropped to 2.5%. We saw unemployment rising over the last 3 or 4 months. And this last Friday, it showed that it dropped. So if it drops and then inflation comes down on the 10th, we may see the Fed say, you know what, we lowered 0.5%. It's working. We're not going to lower it anymore in 2024. So their rhetoric changes, their action changes from what they say they're going to do. And so we continue to monitor that data as we make decisions on investing cash and giving clients advice. And then, there's the election coming up. We did an election special in July, and we're going to repost that because, again, we're getting more and more questions about what's happening with the election. What should I do with my investments? You see, celebrity investors, on your news feed, whether it be a hedge fund manager or the owner of the Dallas Mavericks, saying what they're going to do if so-and-so gets elected. And again, we don't want to follow any of that emotional argument, because news articles make money by getting you to click on the title. They don't make money on giving you solid financial advice. And so that's what we're there for. We use the data, and we look back at the data, and the data are very clear. They show that, regardless of who's in office, that the markets are going to perform. Companies are going to find a way to provide value to their shareholders, regardless of who's in office. However, leading up to the election, there's uncertainty. And we talked about markets not liking uncertainty. So when the markets don't know who's in office, it's very hard for them to predict what their strategies are. We hear politicians making, drastic recommendations that they're going to make when they're in office. But the good thing about our republic is that, it's not one person who gets to make changes in the tax law or what they're going to do. They're still going to have to run that through Congress. So, very emotional time period. We'll use the data to give our recommendations and make recommendations to the client. But one thing that I know, after working in the government for over 20 years, is that companies are much more efficient and much more effective with their policies than a government where it takes a long time to make changes. So we believe that companies will continue to provide value to their shareholders or find a way to, regardless of who's in office. And we'll send out that presentation that kind of looks at some of the data to hopefully give you some peace of mind leading up to the election and not make any emotional or drastic decisions based off the news cycle.
I appreciate it, Sean. And one other thing that we may start having more conversations about or questions about is those that may have bought a new home when interest rates, let's say 7.5%, 7%, even 6.5%. What about some of those clients that would say, okay, when should I think about refinancing?
Yeah, it really all depends on each client's unique situation, right? Some factors that play in, and we saw this a lot in 2022 when rates dropped from 3.25 down to the mid twos, right? Even low twos, we saw some clients get mortgages at. It depends, right? It depends on your monthly cash flow. It depends on how long you've lived in that home. Because if you've lived in that home for 8 years, refinancing it back out to 30 years, probably not going to be the best option because then you're taking on so much more of the interest that you've already paid down. So what we do is we go on a case-by-case analysis with clients and say, okay, here's what your monthly payment is. Here's what your mortgage is. Here's how much equity you have in your house. If you refinance it, there's a cost for that refinancing. And so does it make sense to refinance your home given the costs that are going to be associated with it? And does it make sense to go back out to a 30-year mortgage? One thing people, right, don't always understand or maybe not have confidence in is, we always see the 30-year loan and the 15-year loan on a house, but you can finance a house at 20 or 25 years, right? You don't always have to re-stretch it back out to 30 years. And then we always say, just be a little bit cautious or wary, right, of, mortgage companies telling you to refinance your home. They make money on commission, right? They make money on the transaction cost. So of course they're going to be pumping marketing materials at you like, hey, your interest rates have dropped 0.25% or 0.5%. So let's refinance. And you might think, oh, that's a great idea. It saves me a couple bucks. But we want to look at the long-term picture, right? How long do you plan on staying in that house? How long have you been at that house? Does it make sense for you? So really it's a case-by-case analysis of does it make sense for you to refinance your property? And then how long should you refinance that for? And don't just think in the traditional sense of a 15-year or 30-year mortgage. There's different options out there, and that's kind of how we help guide clients through some of those investment decisions.
Great. Appreciate it, Sean. Thank you all for listening. If you have questions, as always, use Sean and I as a resource. Send us an email or give us a call. We're here to help. And with that, have a wonderful October, and we'll see you back in November 4th, I think is a Monday. So you'll hear from us back then.
Awesome. Everyone enjoy your October.